We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Greg Weldon, publisher of the Global Macro Strategy Report and the Gold Guru. He's a 41-year financial market veteran and commodity trading advisor. How are you today, Greg? Thanks for joining me.
I'm great, Tom. Pleasure to be here.
So before we started recording this morning, you were telling me that these markets feel very heavy to you. There are, a lot of signs that we're going to talk about, obviously, with a lot of moves from central banks around the world, what that means for all of these markets. But let's start with, basically what we're seeing from the US markets and your focus on that right now.
Yeah, I did a big special yesterday, and if you remember the movie, One Flew Over the Cuckoo's Nest, and Nurse Ratched called to, get the patients in the mental hospital to come and take their medicine was medication time, gentlemen, on the loudspeaker. And to me, it's kind of correction time. It's the same thing. It's medication time in the broader metal sector, because it does feel heavy. And one of the reasons I think it feels heavy is you have this bifurcation between some of the economic data and what the reality of the economic situation is, particularly for households and the consumer. The employment report on Friday was a perfect example. Headline number, celebrated job growth. This is great for the, for the election dynamic, certainly for the current candidates, to put their spin on this. But the bottom line is, when you look at the household survey, the number of unemployed fell dramatically. The number of employed fell by 400,000. The number of unemployed rose. The people that dropped out of the labor force rose. The number not in the labor force posted the second largest increase since the pandemic. So the bottom line and the unemployment rate went up to 4%. So the bottom line is the innards are not healthy in terms of the labor market. It's been that way for a while. And these two different reports, whether this is immigration or some other factors, to me, it really doesn't matter. Even the job growth that we're getting is part-time mostly. And the number of people, I've said this now for a while, and it continues to be true, the number of people working 2 full-time jobs to make ends meet is at levels that every time that's happened has led to a recession. Now, if this is the case and we see the consumer, right, delinquency rates are rising at the pace and to levels we haven't seen since 2007 on credit cards and auto loans. Credit cards, newly delinquent and also transferring into seriously delinquent, are really moving up quickly amid a situation where consumers borrow the most money ever at the highest cost ever to do it. So, of course, there's stress there when we see savings is down to levels below what it was before the pandemic in 2019. And you have an increasing share of disposable income comes from transfers, government handouts, still $4 trillion. The deficit's blowing out. We know all this. It's spending, and we know this. And in this case, the retail sales are still disinflation to deflation on a dollar basis when you consider inflation. All right. All the growth in retail sales is prices. It's not stuff that people are actually buying. They're getting less stuff, but spending more money to get it. So this is not a healthy consumer that's reflected in a stock market with the XLY, which is severely underperformed, breaking down against the S&P. That's always a tell. And when you juxtapose that against Fed policy, which you could argue at 5.5 policy rate against the 3.4 inflation rate, they're punitively tight against an economy that seems to be already rolling over. So to that degree, that seems why maybe there's a heaviness to Fed policy here, the actual policy, not the expected policy, which would include rate cuts. The current policy is kind of heavy for the current economic situation. Commercial real estate's back making headlines all of a sudden. This is a major issue we've been talking about all year long. It's going to come to a head, and it's starting to happen. The Fed is kind of behind the curve almost, maybe. I'm not one that says the Fed needs to rush out and cut rates, because their rationale is inflation's still high, and they're right. Mm-hmm. So this poses them a problem, and I think they would like to see asset prices come down, commodities, and even the stock market before they can declare total victory on inflation. And they're going to maintain this heavy policy that's starting to be reflected in some of the heavy price action that we're talking about.
Greg, do you see any of these, really these consumer costs at this point, even really approaching this 3-4% CPI number? Or is it when you look into these individual pieces, are they all higher than CPI print?
Well, that's a great question. I mean, the inputs into CPI are critical. And I mean, I go through them all. There's like 115 of them in just food alone. All right. So you have a lot of things going on here. And when you look at something that moves, and that is food prices and energy prices, that's why they have a core rate. These things have come way down and have bottomed and are now approaching levels that would suggest they're about to accelerate higher. Mm-hmm. You see the ECB just cut rates, even though the last couple of German monthly inflation numbers are more like 7% again. All right. So the acceleration in the short term's there. Even Bank of Canada cut rates last week. All right. The last two monthly numbers, 0.6 and 0.5, that gives you an inflation rate that's closer to 6% than their 2% target. All right. Mm-hmm. And you can see a lot of these things suggest that this will continue because of the swings that we've seen and can measure against base effect year over year on a lot of food commodities and the energy space. If these things go higher from here, it's a problem for central banks. So going back to all of this where they're cutting rates anyway, it begs the question, and this is to me the biggest theme out there right now, and the answer is a resounding yes, that they are showing a willingness to acquiesce to higher general rates of inflation to protect economies and to protect the consumer in the U.S., who's facing, some real stress, man.
Well, that is a line that I did want to keep going on a little bit, is this stress to the consumer. Is consumer credit starting to show this as well? And then what does that in turn mean for lending standards?
Yeah, absolutely. And two things, again, really good points to make. The consumer, when you see the consumer credit, it's actually slowed dramatically in the most recent month, and it's like it hit a wall. Mm-hmm. And what's happening is you see revolving credit is growing at one of the lowest rates we've seen in years, virtually nothing. I mean, it's gone from 13% year over year growth to like 9%. Then it was steady and 7-ish, right? Sometimes touching 8. Then it was dumped down to 5 or 6. Now it's 0.1. All right. So that's a problem right there in suggesting to consumers starting to cocoon because delinquencies rates are rising. On the flip side of that, we've already heard from senior loan officers in the U.S. that there will be tightening standards and conditions on auto loans and credit cards throughout the rest of the year. So it sets up for a kind of a credit crunch. And I think that what's interesting when you go back to the Fed and to Powell, particularly, when you listen to him speak, since 2018, he's told us exactly what he's going to do, and then he went out and did it. Every step of the way. We're going to let inflation run wild, then we're going to bring it back down using the Volcker playbook. All right. When you heard him speak when inflation was first going up, his words were drawn from Volcker's 1978 testimony on Capitol Hill. I mean, it's verbatim almost, except for one point. And that is Volcker was very careful to say, we do not want to induce a credit crunch. Whereas Janet Yellen and Jerome Powell have both hinted at maybe a credit crunch is kind of needed. And while that's true, you let that genie out of the bottle, man, that's a bigger problem. You're going to try and let a little bit of air out of this giant bubble that's as blown up as ever. That's a dangerous proposition. So I think the Fed will be very hard pressed to maintain that view as it actually starts to unfold. Now, I think the key for them, again, is asset prices. Does the stock market really reflect any of this? You could say the Russell 2000 does, but certainly the NASDAQ and the S&P 500 don't, not yet. And I think the Fed wants to see some of that. So this is where I feel, the heaviness comes in because it does all link back to everything that we have. And when senior loan officers surveys tell us we're going to be tightening this stuff for the rest of the year because it's so kind of egregious right now, that's worth listening to.
Well, and, you make the point that maybe Powell does want this disinflation in asset prices, which, goes back to the idea that I think we talked about quite a few months ago, if not years ago even, that Powell was really trying to break this idea of the Powell pivot and the Fed put on the markets, right?
Yeah. I mean, there you go. And it was funny because just recently someone brought that like it's back, and I'm sure he doesn't want to hear that. And, you could also make a real good case for the Fed in one simple point. I mean, what's interesting is the Bank of Canada basically said, inflation has come down enough that we don't have to remain as restrictive as we were. The Fed could use that wordage right now perfectly to cut rates tomorrow if they really wanted to, because they're plus 200 basis points, and that's against CPI. If their target is PCE, it's even lower, right? So I think that's interesting. But at the same time, one of the arguments that might be made in the room would be, we can't start cutting rates now with the stock market at new highs and gold at record highs above $2,000. Pretty simple. So I don't know.
Do you think that the Fed necessarily really is watching the price of gold right now, or they're more heavily focused on inflation rates and asset prices instead?
I don't know. That's a good question. I'm not sure I know the answer to that question. I mean, I'd like to know the answer to that question. It would be very helpful to know the answer to that question for sure. But
well, that's why I'm asking you.
My guess would be that not as much as I might think they are or want them to potentially, or think maybe I'm overthinking the entire thing, that maybe it is that simple and academic, because let's not forget, these are not all market people to whatever extent they are or are not mostly. And, they certainly don't have skin in the game, which changes everything. I mean, we manage money. My money is about, this changes everything. Give me a researcher who has skin in the game is much more often, some brokerage house guy who's not trading. I mean, that's just that simple. So I don't know with Powell what his approach might be. It might be very academic and is simply inflation, the data, and looking at it. But if you really look at the data, I don't see how you don't understand that the economy is weakening, and continue to say because GDP comes out strong, that the economy is strong. The innards are clearly weakening. Now you get something like the ISM, for example, and it shows a big boost, and some of those increases were genuine. So that the ISM service number recently in the US was pretty strong, relatively speaking. But you could also find cracks in it. When you're talking about new orders rose, but the percentage of firms that said new orders fell also made a new high. So it's also polarized. And there's a lot of firms hurting, and that's increasing too. And then you look at the backlog of orders, and it's actually shrinking and has been shrinking for months. So the pipeline is dry, and even though the front end looks pretty strong sometimes, it's not always supported to the degree that it needs to be sustained through what could be a consumer spending slowdown. And when you look at the Fed household survey that the New York Fed does, which is a treasure trove of information, you have consumers telling us they are much worse off to a greater degree than they were before the pandemic. It's that simple. And what they're doing now is, especially the lower income, as expected, not a shocker, have cut their spending growth, all right, still growth, but cut spending growth dramatically in the most recent surveys. So they're expected 12-month forward spending growth rates. So I think that's significant tell right there too, that ties into everything we just talked about.
Yeah, it seems like that order book number that you're talking about, that's really a lagging indicator on the, as you said, the front end of that order number.
And it's what they call soft data. It's a sentiment-based number. It's not hard data, meaning actual production in tons and that kind of thing.
So, Greg, going back to this idea of, Powell trying to channel Volcker or really repeat that playbook, how do you see this almost acceptance of a higher inflation target, this 3 to 3.5% inflation target versus 2%? Does the Fed really have an ability to combat this type of inflation at this point?
Well, I think not. I think that's the problem. And the reason is twofold. Number one, you've had a 40-year downtrend in interest rates and inflation, all right? That hit a level that you can't breach anymore. You can't go into negative territory that proved to be folly. I mean, people are going to stash their money. And if they're telling them that things are so bad, we're not going to be raising rates for the next 2 years. That was the wrong message to send psychologically. So when you look at that, but overriding all of this is debt. You have so much global debt, over $300 trillion worth globally, especially in the US. We know the situation growing exponentially now. All right. That you need growth to cover that debt. You're going to need higher rates of growth. You can't accept subpar. You can't accept inflation, level rates of growth to service that debt, or you have a debt deflation, which is the worst case scenario. All right. And in that context, they're going to be forced to acquiesce to higher rates of inflation to keep growth higher. And that just means, again, higher, we've gone through 40 years of lower lows and lower highs, and that trend reversed, pandemic accelerated. It's not the reason, but it definitely accelerated because the debt accelerated, the inflation accelerated, everything did. It went really into hyperdrive that allowed you to escape the gravity of a 40-year downtrend line, if you want to look at it that way. And from that context, you've had the big move, you've had kind of the correction, and I think that signs are that the next upturn's already started, just as central banks are cutting rates. Now, you would say that would be really good for asset prices.
Upturn in inflation.
Yes.
Yeah.
And I think that would be good, obviously, for asset prices, but particularly gold and even equities when the Fed moves. Because I think we're kind of all waiting on the Fed as the leader of the pack. They're tight right now into a weakening economy. And I think when the Fed moves, that's when the dollar gets hit. And that's when you see the real big moves start. And we can even equate that to some of the action in the mining shares that tell us the real big moves haven't even started yet.
Mm-hmm. Greg, I've heard you say that you really dig deep to try to understand these numbers. What metrics do you look at in the case of inflation to really try to understand what trajectory that is on, rather than, obviously looking at CPI or some of these maybe inaccurate numbers, as you said?
Right. It's funny because, if people want to, say this number versus that number, this is better. There's all kinds of inflation indicators, that's for sure. Cleveland median CPI, the Atlanta has their own, sticky CPI. So I would say, first of all, that the numbers are always what they are. If you understand and, know and read, footnotes and descriptions, which I did years ago, so I don't have to do that all the time anymore. But knowing what these numbers are, what comprises and generates these numbers is important, because then you can accept them for what they are, because they are what they are. And that's, are they massaged? I would say not usually, until the most recent bunch of labor market numbers, frankly, from Friday particularly. But then I want to look at timelines, and I want to look at the inputs on various things. Then I want to look at the individual inputs and the timelines, and then look at, is there a fundamental story in each of these inputs, which of course is mostly the commodity-based stuff. Certainly, simply, or you want to make this as simple as possible, like for right now, even stuff like PPI, especially when we saw in Canada. I mean, all of a sudden, industrial PPI in Canada has kind of scorched back to the upside. And these are things that pay attention to. Why? Because it's a leader. So when you see the short-term indicators turn relative to the longer term, when you have an idea of individual, components of what their fundamentals might be, then you look at what were they a year ago. Then you look at, like I said, the monthly numbers annualized. You can see the acceleration or the deceleration. It becomes a largely mathematical, process, but also a fundamental process in terms of all of the components. And there's so many of them and then you also have to look at, all right, really the percentage of which the overall CPI is derived from each component, because you have situations like in China where food is a much bigger component of inflation than it is in the US. It's pretty small, relatively speaking, to the US. And then you want to say, well, what is that relative to how much money people actually spend? And a good example of that is recently to say, well, you want rent to come down and everything. And it's like, well, rent's going to come down and rent's going to come down. The rate of inflation has definitely softened. All right. It's gone from like 8% to like 5.5%. But the bottom line is, this is a payment that probably takes up the biggest payment of your monthly budget. All right. It's skyrocketed. It's not coming down. You're not going to see big negative numbers, at least not yet. All right. And I think the degree to which these things are kind of underaccounted for when you say to yourself, what is the impact on inflation for consumers and their spending habits? Because that's the single most important determination. And right now, that determination is very clearly when you see every dollar of retail sales, and I do this by hand because they don't give you these numbers. I take the dollar values of everything. You can't always do it. It's not black and white, because each component is different and then the inputs are different. So you do generalize sometimes, but it tends to be very telling. All right. We're always looking for tells. I think that's the biggest thing. It's like a high stakes poker game. What are you doing? You're watching every player, every move they make relative to moves they made in the past. All these kinds of things come into account, and you're getting tells from each of them and basing a decision, on all that information.
Mm-hmm. Yeah, that's actually exactly where I wanted to go next, was asking you how this consumer expectation of higher inflation changes their behavior. But Greg,
it causes them to hold back on spending, or actually you could say it causes them to spend now because otherwise they think prices are going to be higher in the future. And I think we've seen that already, and that's now fizzled out because they can't afford to spend anymore. So we've reached that tipping point already, I believe.
So Greg, how difficult do you think it is, especially this year, for Powell to be able to try to remain apolitical going into one of probably the most divisive elections in U.S. history?
I don't know. I mean, that's an impossible task. You couldn't pay me enough money to do that job, frankly. No, I really couldn't. I mean, forget it. No, I'm very happy to hear my cave digging deep into the data and not having to deal with all the external stuff. Gosh, Tom, I don't know. I mean, that is the big question mark out there. I think when I think about that, I don't necessarily even think about Powell. I think about bigger picture stuff. I think about, these sanctuary cities where a lot of people are living outdoors in tents, and it's going to get hot this summer. And oh my God. And, you see kind of, the situation with part-time employment versus full-time employment. You have, people that are in position to potentially be in conflict with one another all over the place. So I think some level of social unrest could become an economic negative that could lead to, be a catalyst with all the other things we just talked about, to cause the Fed to have to react in a way that maybe they don't want to react, but almost have to. If you have lockdowns and social unrest to the degree that you are having curfews and stuff. I mean, I heard this from my daughter who lives by the Jersey Shore, right, where we grew up, where I grew up, where she grew up, where I raised my two kids on my own. So she's telling me that they now have curfews on the boardwalks on the weekends, 10 o'clock for anyone under 18, which is interesting. I mean, I don't necessarily disagree with that, but people are going to fight that as you're infringing on my freedoms, because they've had teenagers with shootings and stabbings already in the summer, like Memorial Day weekend. In New Jersey, on the boardwalks, where it's usually party central and everyone loves everybody. So if that's the situation to which it's degraded there, I think that that's a microcosm of much worse things that we'll see across the country in the next couple of months. And then the election results, holy mackerel. It's almost like either way, it's going to be a nightmare. So I wonder if the Fed feels, the bigger question that would be, does the Fed feel they may have to get out in front of some of that? I don't know. That's a good question that I would be asking the Fed.
So, Greg, how does this all translate as well for the banks? Do you see, the possibility of more bank failures? As we know, there's still a major duration mismatch in assets held by many of those institutions. Yeah,
it's a ticking time bomb to whatever degree. I mean, $1.5 trillion, some of it's been whittled down, but it's still well over $1 trillion in commercial real estate debt comes due in the next 12 months. All right. Regional banks hold 80% of that debt. That's the problem. And when you look at the banks have done very well. If you're one of the top tier, what they used to call money center banks or investment banks, the Goldmans, the JP Morgans, the Wells Fargos, and anyone linked to consumer lending like Capital One and Bank of America. These have been the stellar performers in the stock market. All right. But you look at the regional banks, the community banks, and there's ETFs for both of them, the QABA and the KRB, I think it is, or KRE for the regionals. They've done much worse. They took a big hit when this commercial real estate story first came out. It certainly took a big hit last March, and then have rallied back and done like some pretty close Fibonacci retracements back to long-term moving averages, and now they're coming off again. So I think it's like a story I wrote about this maybe 7 or 8 months ago first, and all the details, which banks, how much. It's the banks less than 10 billion in assets have 35% of these loans. So you're talking about $400 billion for banks that have less than 10 billion in assets. I mean, that's a real problem for the smaller banks. What does that mean for lending and availability of credit? So that's another big question mark. And I do think it's an issue. And the other thing I always like to look at too is when you look at the banks, even though they've had this rally relative to the stock market for the last 25 years, banks, even JP Morgan, have been flat versus the stock market. They really provide no value add, no alpha add, except in short bursts like we've had here with the Fed remaining higher longer, benefiting the banks to whatever degree, but that's not going to last either. And I think there is problems out there. All of a sudden, again, I know all the data, hard data, and all of a sudden now you see a story, some of these firms are having to actually sell their buildings. And now all of a sudden we're finding out what they're really worth. And it's like, oh my God, now we're having a second epiphany of how bad this could be, because you're actually getting some idea of what the market is for some of these some of these commercial buildings. And San Francisco, it's down 40% already. I mean, come on, that's going to be a problem for these banks because they're going to eat a lot of these losses. And I read about one bank actually this morning, and they were so proud that they lifted their loan loss reserves by 78% this quarter, right? It was $119 million, like pennies. And if that's 78%, they have $250 million reserved against losses that could be in the billions.
I was going to say 40% markdowns in San Francisco seem pale by comparison of that St. Louis building, I believe that it was something like 90% write down. It was insane.
A lot of them are like that too in New York and several in San Francisco. And even what's funny to me is even some of the financial firms, I won't name names, own these buildings, okay? And then dumped them, basically wrote them off 3 years ago. And now they're putting more money in. And it's kind of like, okay, wait a minute. It's like the guy, I won't mention names, but a particular woman that's hot in the crypto circuit and whatever, the meme circuit. And, she's down 80% for her clients and she still gets interviewed on TV all the time. So it's like, sometimes you got to watch out who you're listening to. And, to the degree to which people that lose a lot of money can kind of still come back around and as if they never lost a dime. And it just blows me away. So, but that's definitely true right now with what's going on in CRE. And right now that means more dumpings of properties on the lenders and more loan loss write-offs that are not accounted for yet.
So Greg, we kind of touched on the Bank of Canada and the ECB starting to cut rates here. What does that in turn mean for the Fed and the dollar?
Yeah, that's a problem because what it means is the dollar higher right now, even though, you had the situation where the interest rate differentials were narrowing, the U.S. premium was coming down. Even last week when U.S. rates spiked up because, it was just one of those weird things that you had this big reaction in EU rates that then reversed. So I don't know. I mean, I feel like the dollar is a problem when it becomes a problem for the Fed. And right now it's probably not a problem for the Fed for all the reasons we talked about, because a higher dollar directly, the tightest correlation of any markets is the U.S. dollar and the S&P 500. U.S. dollar down, good for stocks. U.S. dollar up, not good for stocks. That's simple. And right now the dollar is into a mini breakout that frankly, I'm kind of surprised to see, and I'm not sure I believe in it or I think it's going to last, but it's there, it's happening. And it is because the Fed is, still in the starting gate and these other horses are already out on the track running. And that, is supportive to the dollar as rate diffs continue to hold. You're getting paid more to hold dollars. So having said that, I see currencies that show promise: British pound, Swiss franc, Kiwi dollar, even the South African rand all of a sudden doesn't look so bad. So I really believe the dollar's kind of living on borrowed time. And when the Fed does move, the dollar's going to get whacked and you're going to see all these other things rise. But in the meantime, it's rallying because the Fed is, again, still in the starting gate. And that's why these things feel heavy right now.
Greg, I heard you say as well that you really see a next round of debasement. So how do you see that next round of debasement for the dollar, and how does that end up kind of manifesting in the markets? Or what is the catalyst for that, do you think?
Yeah, that's a good question. I mean, there could be several catalysts. One of the things, I've always enjoyed doing, particularly worked in the hedge fund world, in New York City, was when we just sit around and theorize, what if this happens? What if this happens? What if this? And then understanding what we might think would happen in the markets. And then when you start to kind of see it, you almost recognize what's happening because you've discussed this potential outcome, for weeks, and you know what you want to do. So to me, doing this kind of thing is always really beneficial to the degree that the first thing that comes to mind is the stock market. I mean, if you get this situation where all of a sudden the consumer is kind of exposed as the emperor with no clothes type of deal, that will be really kind of a wake-up call for stocks, a kind of a economic reality check for stocks. And I think that could lead to significant one-off declines that would cause the Fed to have to move. That would bring the dollar down. I have also talked about, and just recently was doing another interview where for the first time I heard someone else bring it up, the Plaza Accord in 1985. And I was in the markets then. I worked on the Florida Commodities Exchange in the gold and silver pits at the time, right? And I lived in Hackensack, New Jersey. Used to take the train, downtown to Manhattan every day, about a half-hour ride. And I just remember we had a little Quotex machine because there was none of the cell phones or nothing. And it came to light that Jim Baker was the Treasury official, I believe, that basically got together with G7 over the weekend and said they're going to move the dollar lower because it was crimping growth and all this kind of thing. I think that you're going to get to that point again where the dollar is seen as something that needs to come down, and that could be another kind of mini Plaza Accord. But the bigger risk to the dollar, of course, is China and Russia and the other side of the world and all the things we talked about in terms of this is already a world war. It's a resource war. And China has the nuclear weapons here in the dollar card if they want to play it. biggest importer and exporter by far, 3-2 of anyone, the U.S. being second. And they say, we want renminbi for our exports, and we're only going to pay you renminbi for our imports. Is that steps away? Maybe, but that day's coming, and that's the dollar card. And I feel like that's going to come in context with North Korea moving on Korea, China moving on Taiwan. Stay away, we'll play the dollar card. Just in a scenario that maybe happens. So this is why we'd love to create these potential scenarios. Mm-hmm. That would be a real big dollar, down. That would be, really, you talk about the monetization of gold would take place right there, and gold would be much higher very quickly. And that's one of the reasons you always want to have some gold, because that day you might not see it coming. It could be a plaza accord of a totally different, the proportions and type. So those are some of the things. Other things that I worry about certainly are, food supplies, supply chains, all these kinds of things, weather, natural events, because, one of the things is the science around this planet, where we are in the Milky Way and how highly charged it is and how the resonance of the planet is rising. And that's why you're having all this disturbing weather. It's not because we drive SUVs. This is so much bigger than us. We can't control it. Climate change is all about creating economic growth and having an engine of growth, because we have so much debt. So people that don't see through that don't really understand it. But nonetheless, the natural events and the type of, just disasters and type of, upheaval naturally on this planet, that's going to intensify. Absolutely. And so that's another big kind of risk factor on the backdrop of, all currencies, all paper currencies. And then you have this situation where you have this bigger inflation, and all these countries try and print their way out of it. And you go back to what I called in the 90s, when we had the Asian tigers all fighting and they all collapsed, the competitive currency devaluation raceway, where all the currencies are like cars racing around. And we used to even say, like, the pace car was gold. And then when they did the gold standard, took off the gold standard, took the pace car off the track. And all these currencies can race around as fast as they want to go. Mm-hmm. So I can see us going into a situation like that as well.
So this is all why you want to have stuff instead of paper, right?
Yeah, pretty much. Simple answer on that one. Yes. All those reasons, all those potential landmines that could be stepped on, and some of them are going to be stepped on. It's that simple to me.
So then what are some of the defensive plays that you're looking at, Greg?
Well, that's the stock market has been interesting, because you could you've seen this rotation, like out of infotech, believe it or not, and into staples, materials, and even the utilities. Now that's come back a little bit, but when you saw that decline, that is precisely what happened. And I thought that was really interesting. So if I see that start to, materialize again, I think that that's a position where you could actually want to be short the U.S. equity market. So we're futures traders, and I think that's the most beautiful product instrument out there, because you can be long or short anything. Bonds, stocks, currencies, stock indexes anywhere in the world, all the range of commodities, from the tropicals to the softs, right up to all the metals, all the energies, alternative and petroleum. So from that perspective, when I say defensive for me is aggressively defensive by being short the S&P 500. And I think you're not there yet. I mean, you need to see some technical, distribution, so to speak. But I think when you look at a lot of these stocks, they're widely owned. Like some of these stocks, anyone that wants to own them, owns them. The passive investment is through the roof still. So I think you still have a situation where, if you even get just a profit taking move, some of the stocks are still priced. I mean, I thought it was really brilliant of NVIDIA to, go for a stock split. At such a high price, if you go into a decline where people are kind of liquidating and taking profits, you're not going to have any buyers of big blocks. And I mean, so I thought that was brilliant, but still a lot of stocks are in that category. And that's kind of a bigger risk that's existed now in the stock market for a while. And you see every so often, you get these little vacuums of buyers, you get these downdrafts. And one of those downdrafts, given the backdrop, could lead to something bigger. You just need one big break, and all of a sudden, all this stuff matters. And that's when you get a bigger picture decline. So defensively, to me, is being aggressive on the other side.
Mm-hmm. So, Greg, we talked about earlier this correlation of the dollar to the S&P, and it used to be that the dollar was very inversely correlated to gold as well. Has this relationship broken down quite a bit?
It's broken down completely. Now, does that mean it's broke? I wouldn't say it's broke, but it has broken down 100%. But I think that is perhaps the most telling thing out there. And this is something that really kind of goes back a couple of years now, where people really kind of got disappointed when gold got up to 2000. It didn't take off right away. It's like you had one of the strongest dollar periods we've seen in the last several years at that same time. The fact that gold wasn't breaking down to 1600 was telltale on its own, because the dollar would have put it there, and it didn't do that. So to me, this is where gold has now broken clear of it. And in the sweet spot, you know, and I know, and everyone listening probably knows, the sweet spot is when gold is appreciating in every paper currency on the planet. And you had that period of time. Now, where we go from here, I don't know, but I'll tell you, I think, you know, when the dollar does go down again, that correlation will come back in the positive with the dollar down that didn't come with the dollar up. So I don't think that the relationship's broken. I think just one side of that doesn't really work anymore. Why? Come on, man. I think everyone on the planet, and I say this just kind of generally to officialdom, it's like, come on, man, what do you think? Because you're printing so much money and the debt is ridiculous. The U.S., I know that in February, the U.S. budget, they spent twice as much as the revenue was. All right. They're doing this thing where it's okay, it's public borrowing, okay, borrow from we the people. But then what they do is they sell bonds to we the people, and then, you know, they print the dollars that devalue the value of the bonds right away. And so if you kind of look at this, let alone the Social Security, and I say this a lot, so if you've heard this before, excuse me, but it's so important to what you just asked. The divergence of gold versus the dollar comes for these reasons of confidence in the U.S. When you see a situation where you are taking Social Security in from the young people, right, to pay the benefits of those that are cashing out. If this was an investment fund, you're taking new investor money to pay the people that want to cash out. That doesn't work. You know, you end up in prison for that. So this is an issue where people get it, man. And this started really way kind of before the pandemic even. And I remember being in Palm Beach, you know, I know a lot of people that are way wealthier than me. It's just kind of sickening sometimes, but whatever. They're all very successful. And they tell me they feel uncomfortable. And that's a problem. And that relates back to the degree to which the government is debasing the dollar every single day in some way. And ultimately, it kind of comes down to standards of living, frankly. And you can see the decline right now, just in the stats from the New York Fed, as to how many people feel worse off than a year ago, expect to feel worse off. And these kinds of questions are very specific. And the answers are kind of blow you away and tell you how stressed out people really are out there.
So, you know, you mentioned the stock markets being at all-time highs, and let's look at a couple stock markets around the world. Let's say Argentina, Turkey, Nigeria. Yeah. These are all trading at all-time highs as well. Yeah. And we need to couple that with the understanding of the debasement of their currency. Yeah. So have people invested in those markets kept pace with that devaluation?
No, it's exactly the point. And that's why I say stock market will benefit from a lower dollar too. It'll go to new highs like every other market. It's exactly what's going to happen. And you nailed it on the head. And I say this all the time. You know, Pakistan, Angola, Turkey, like you mentioned, all of them at record highs. But you don't keep pace with the devaluation of the purchasing power of the currency. That's the bottom line, especially when you look at Turkey. When you look at average wages in Turkey in dollar terms, okay, from 2008 to where they are now, the average Turk in 2008, the average monthly salary would have equated to $140,000 a year before the pandemic, before the crash in 2007. Mm-hmm. Now you're talking about $4,500. So imagine having a family of four going from $140,000 to $4,500 in terms of what your money buys every week, every day. And so stocks are at new highs. Who cares? Mm-hmm. It's about the standard of living being at a new low, and the amount of the purchasing power of your currency being at a new low. When you look at the peso and the devaluation there, when you look at the lira, when you look at the Pakistani rupee, the Angolan kwanza, any of these currencies, and Angola, I say because they're, a major oil producer now producing, 2/3 less than they could at capacity. And that could make a big difference if they were producing crude oil in terms of supply. Mm-hmm. But they can't. Why? The currency. Another real good example, okay? Ghana. Their stock market's at a record high. The SETI is getting crushed. That's their currency. And what happens as a result? Farmers can't afford to take care of their crops, and so you get a little El Nino impact on the weather, and all of a sudden cocoa is going to prices no one ever would have believed you would see. So I think that in that same context of that question, expect prices like you've never seen before in stock markets, in commodities, in even crypto, because that's what's coming in dollar terms when all this kind of mutates into that.
So obviously that's what makes gold so important in many of these other currencies, never mind the US dollar as well. So, Greg, how are you seeing the gold market right now? Do you consider open interest? How do you try to get your finger on that pulse?
Yeah. Well, what the research proves, research I've dug into, and from other statistics I've seen, from various, private people and from government entities. The biggest buyer of gold, in this entire run has been China. Right. Mm-hmm. So the degree of, it's really a ridiculous amounts over the last, say, 28 months or so. It's really been huge. Having said that, you've seen this whole thing with gold, where open interest on the, on the COMEX and the futures on the Globex has been really low. Just recently made the big run when gold made its recent high. It's come off so fast in this decline. Gold reversed $100 on Friday. Open interest collapsed, and it's back down to levels below where it first broke out. So it's like, from a speculative position, or whatever the easiest way to rotate into gold would be to have an allocation, it's almost like nobody owns it. Mm-hmm. Silver is not the same story, which is interesting, but let's focus on gold. And from that perspective, when we know that it's like China's been buying the gold, it seems to me that there has been some gold available above $2,400. It's not coming from China. They're holding this gold against their reserves, and bigger percentage of their reserves, and it can back their currency eventually, blah, 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 all this stuff that's absolutely true. The bottom line is, I think that this, and I said this, I think the last time I was on with you, that this is a thing where the open interest does suggest that people don't trust it, and they're quick to dump it, and they don't always own it to the degree they probably should or want to even, and they're going to continue to chase it higher. And this is what's going to happen. You have these big spikes and then these big downs. So it's going to be very volatile. And it's funny because I was talking to one of my clients maybe a month ago, 6 weeks ago. And I told him, I just remember the days in silver when you would come in, it would be locked limit up $1.50, trade limit down $1.50, meaning $3 move down, and then finish lock limit up $1.50, right? So the moves were amazing. And it was the very next day, the gold was like $50 and then down $60. It was just too weird that I thought of that. And the next day, talk about the mind working in weird ways. Mm-hmm. But anyway, I think you'll see more of that. And that's going to be difficult for, short-term people or people that are not strong hands, so to speak, to kind of deal with. So I think this is a stair-step type of thing where people will continually chase this market higher because they want to own it, but they don't really trust it for some reason. And they're very quick to dump it, because frankly, they've gotten burned in the past. And frankly, the dollar's still not in play. And I think once the dollar's in play, you won't see that happen as much. The open interest will be more of a one-way street, but it hasn't been.
So why is silver a different case at this point?
I think silver is more owned. It's cheaper. It's, I just feel like it's owned by a different crowd that is also a little more loyal, frankly. Silver is a very tightly held commodity. People that love silver absolutely love silver. It's like being a New York Rangers fan. You love them even though they collapse in the playoffs every year, right before the finals. So you got to say to yourself, okay. But at any rate, I think that it's very impressive that silver has been holding around this $29.90 level, because $30 was the breakout. So to me, this is a market that either has a deeper correction coming or is going to hold right here. And I know that sounds like, okay, you're really playing both sides of the coin here, but I really believe that. And I think silver will be the telltale. And if silver can hold where it is, that will be really bullish. Mm-hmm. Having said that, the entire sector looks heavy. The special we did just yesterday, which I'm happy to send to any of your people, identifies all the buy zones on the downside, the Fibonacci's, the long-term moving averages. I have what I call my double kill zone, which is between two major moving averages, most often the 52-week and 2-year exponential moving averages. The 2-year exponential moving average, amazing at calling long-term trends. It is the long-term trend indicator of all time. I've been doing this for so long. This is from experience. In the shorter term, it's the 100-day and 200-day exponential moving averages. And when you have those moving averages, they are now, they're still rising, all right? And then you have your Fibonacci retracements aligned with two of those moving averages, That's what I call the double kill zone. That's what you're looking for in a correction, and it is correction time, gentlemen, correction time. Then I think that's what the strategy is right now, because you've had a lot of liquidation. I mean, look at a silver miner like Fortuna. It was a great upside performer, and it got just wasted on Friday. So we're looking at all the range of individual mining shares, the ETFs, and the underlying metals. Where are the buy zones? Because I think this is a correction, and you're going to want to load up, because I think the next move will be something bigger picture. And from a tech perspective, even supporting that thought process, you had the one decline, you had the renewed rally. Maybe it's ABC to the downside. That's especially looks that way in crypto, and I think they're kind of correlated. Ethereum and Bitcoin kind of play into this, and it looks very. We just had the B wave rally. We're about to get the C wave correction, and that's going to be the point of attack from there. Going higher beyond that.
So then where does platinum fit into your thinking in there, in that complex as well, Greg?
Just finished a special on platinum this morning, so good timing on that one. It's breaking down. The only place it's not breaking down is Tocom Yen Platinum. So if that breaks down, then it's a bigger picture breakdown. Palladium is back towards its lows, so that would be an interesting one. Having said all that, it's still kind of fundamentally more positive the lower it goes, too, in terms of, you maybe have some deficit situation now. You don't have the surpluses that we've seen the past bunch of years that's really kept it down, and especially that. But it's also breaking down against gold again. So I think it's vulnerable here, but I think there's value in here somewhere, and you're not far from it. I can't help but shake that thought. We got long platinum. We got stopped out. We took a small loss. I'll try it again. But what I find even beyond that is a couple of the mining shares, like Impala, for example, in South Africa. They're kind of in a situation where they look very double bottomish. The rand looks like it wants to break out. It's maybe premature because the dollar is strong, but if the dollar gets weak, I think the rand could be one of the better performers out there, because it hasn't gotten any benefit from any of this in the precious metals at all, currency-wise. So I watch those stocks. I think Impala, and what's the other one, the big one, Anglo Platinum. Because those stocks, to me, have great patterns where you're going to get a clear-cut upside breakout pivot that is kind of short-term, give you good risk-reward metrics, and they're so cheap, it's almost like a call option on platinum. You buy them, put them in your back pocket, you're willing to risk everything you put into them. There's no time decay, there's no expiration date, and it will benefit if platinum does go higher, which I think ultimately happens, but it's been a non-starter so far, that's for sure.
So I was going to ask, Greg, how do you look at the miners at this point? Are you, being very selective? Are we at a point where you don't really want to get into miners? How do you see, the mining sector as a whole?
Yeah, the mining sector has made moves towards breaking out against the metals. So, on a ratio basis. So that's something I watch closely. I watch all the ratios. All these interrelationships are really important, because they'll tell you something about the bigger picture. I mean, you want the mining shares to outperform. That's when it's usually the hottest. But of interest, and interesting that you asked this question, I just wrote about this yesterday in our special. When you look at some of the mining shares, what is apparent to me is the lower priced, dare I call them the more speculative shares, particularly in silver, have been the better performers. What's lagged? Newmont and Barrick, I mean, they're, just going nowhere, right? And in fact, Newmont got right up to the 2-year exponential moving average, where it failed the last time it got up there about a year ago, failed again miserably here. So to me, that's interesting, because normally you would expect the lower priced, more, if you dare call them the speculative stocks, lead at the end. This is the frothiness of the market, right? When everyone's plowing into the cheaper ones, trying to catch this, get rich scheme as they're riding this tidal wave that's already taken place for a while. What if the script is reversed now? And I love to think about things that change demonstrably that people don't necessarily think about. If this is a case where when the enthusiasm gets really heightened, it's the big cap blue chip behemoth, the benchmark Newmont Barracks, that lead the way. And they do so because at that point, the gold in the ground that's not even being mined all of a sudden becomes more valuable. And now when you see Newmont break out above whatever level that is, it just made a high. I think it's 45. I could be way wrong. Looked at so many charts yesterday. But that and Barrick, that will be a telltale sign to me that the enthusiasm's starting to take it up a notch. So when I look at the dynamics around, the mining shares, I want to see them start to break out against the metals. They made some roads towards that. I want the GDXJ to break out against the GDX, the junior miners to lead the way. We've seen some moves there. I want to see SIL outperform GDX. We really haven't, we've seen some moves there. We haven't seen these break out, to the degree that I would like to see against the S&P 500. So that's another way I want to look at these. But, having said all that, I think one of the more interesting things that I've found in that examination, and I've been watching this, for a couple of months now, is Barrick and Newmont and their underperformance, and how them breaking out would signal a new heightened level of bullishness around this entire sector.
Mm-hmm. Excellent, Greg. Well, I think that's a good place to kind of wrap up for today. Do you have anything you'd like to leave our audience with to think about before we do?
Yeah, I mean, just again, I think the thing that really strikes me these days is, and somebody said to me, I was on another program and somebody wrote in one of the comments, is like, this guy talks about the physics and all this stuff, but he won't make year-end projections. It's like, well, I have places where I think things may go, but I'm not putting out official, projections, because first of all, that implies I want to sell stuff there. Right? Mm-hmm. I want this open-ended. I mean, the biggest thing you got to do is cut your losses and let your profits run. And that is so cliche, but it's huge proportionally important to doing this successfully. So what I would tell people is never, don't think something can't happen, and don't think that some price is unreasonable for things to go to, because you're going to see more and more cocoa markets where it triples in price from the record highs that no one ever thought could get there. And you're like scratching your head, like, how did I miss this move? Why did I get out at the peaks from 10 years ago? Throw the history out the window in a lot of ways, and just let things run, and enjoy these markets to the degree that they probably come with some more uncomfortable things in life, frankly. So we'll see what happens.
Mm-hmm. Greg, can our listeners email you to get a report or two from you?
Sure, absolutely. We have the platinum report I did this morning, the big gold and silver, all the individual mining shares, the ETFs yesterday. We actually did working a really good report on Canada and one on the U.S. in terms of budgets and all the fundamentals there for the central banks. So any of that's available. Sales at weldononline.com, WELDON online, one word, weldononline.com. Shoot me an email. I'll give you all that. We also, Series 3 registered CTA here in the U.S., and we're currently accepting new accredited investors. I think the opportunities here for CTAs, not just me, but there's a lot of good CTAs out there. So, go out and research and find a good one that you feel comfortable with, because this is a better way to keep pace. When you talk about before, stock markets, passive investing, not keeping pace, that's the biggest thing going on right now in the future for the general investing public, especially here in the U.S., where so much money is passively invested and so much of that money is in the same stocks. Mm-hmm. This, to me, is the biggest kind of faulty way to look at things going forward, because if you don't have the ability to be exposed to some of the things that a CTA can be exposed to, especially across the range of bonds, commodities, and currencies, you're going to have a harder time keeping pace. And I think that makes what I do and people that do what I do become more valuable here. So, and I say that because I mean it. I've not said that for 40 years. I mean, I'm saying that now because it's true. And I think that if you look at the situation, you understand that that's true. You're going to need exposure to other things in other ways to try and keep pace, things that will keep pace better, right? Directly in the currency. If you're in the currency, you're going to keep pace better. If you're in the commodities, if you're in the gold, and then not in the gold all the time either. I mean, you could pay not to be in it when it's going to be coming down. So there's a level of market timing here too. We're not short-term traders. I want positions for months, if not 18 months, a year and a half, 2 years. We've had those as big positions. But I'm also, if I'm in and out in a single day, it's because I was wrong and we got stopped out. It's very important to manage the risk. I think the mistakes that people make for trading futures is being undercapitalized. You have to understand the math. This is really easy if you understand the math, because you take the notional amount of the contract, you take what you want to risk. We risk the same amount every time. We're talking 0.4. 0.4% is our per trade risk. Then we look at risk on the entire portfolio, the value at risk, the margin, what's our leverage. All of these things are really important. What's the sector risk? What's the correlated risk? All these things. And I think that people don't really do enough work on the math of, the risk of ruin and what the value of these contracts are and what your real risk is. And I think it's really difficult for people to do this themselves if they have 50 or 100 grand. It's just not enough money these days. One gold contract's twice that right off the bat. So, I think that looking at the professional side of this as a part of your portfolio, never all of it in anything. But a lot of people just have all of it in passive stock market investments, and they feel like they're diversified. And it's like, no, you're really not.
Excellent, Greg. Of course, you're available on Twitter as well at Weldon Live, and also the Money Podcast at Money_podcast. Greg, thanks so much for sharing all of your info with us today. Really appreciate it.
Yeah, my pleasure, Tom. You do a great job, so I'm happy to contribute.
Thank you, sir.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.